All right, I'm Michael Hartzman. Today is Tuesday, May 26, 2026. So this is the Lebenthal Report, and I'm on as always with my partner, Dominic Tavella. How are you, Dom?
Doing great, Mike. Nice long holiday weekend. Hopefully you were able to enjoy it.
Yes, we were. Thank you. Same to you. I know you're down in Florida based on you're a different location. But I think we had a little nicer weather. We had mostly rain, but it is what it is.
Listen, I was grateful to have the day off. I didn't really much care about the weather. So one day to escape reality and watch our Knicks win was a great weekend, Mike.
Yeah, not, yes, they've been on a yeah, we can make this a sports talk show for an hour, Dom, if we wanted to, because they've been on a magical carpet ride. But I don't want to jinx it. We still have one more round to go.
We'll look forward to that.
Exactly. Um, so look, let's just do the numbers real quick, and then I'm going to ask you the first question, which is kind of a loaded question based on these numbers. S&P 500 quarter to date up 14.6. As you pointed out, we're still in a quarter where the Iran war started. So there was a bit of a bounce back from that. But year to date, the S&P's up almost 10%. The NASDAQ quarter to date is up 22%. Again, same factor with the war in Iran. But year to date, it's up 13.6 through Friday. And the Dow quarter to date up 9.4, year to date up 5.9. And Dom, the question clients keep asking me, and I'm sure they keep asking you, is why is the market continuing to go up with all the news that's just swirling around?
Well, I wish I had an easy answer to that one, Mike. So I appreciate you throwing it out there for our discussion. But I want to go, and we'll look at it simply at first and then dig in a little bit deeper as we go here. Because earnings have been that good. If we're in the midst of towards the tail end, but in the midst of quarterly earnings season, companies tell us what they have done, what gross revenue, what earnings profits are, and maybe give us a little bit of a guidance for the future. And I know this is really hard to believe when you look at the headlines every night, and Lord knows they're not great. It's downright frightful. We talk about headline risk all the time, Mike, but the reality is that corporate America is figuring it out, and part of that means their profits are that good. And the first stat of the day, 88% of the companies that have reported earnings have beat the market expectations. And even if you think those expectations were low, doesn't matter. 88% have beat market expectations. And as such, the market's kind of reacting to the noise rather than the news.
So I agree. And as you know, I talk about it all the time. I use the weekly market recap from JP Morgan as my cheat sheet. And they threw a little bit of a wet blanket on 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 your hypothesis. Not that it's wrong, but what JP Morgan wrote yesterday is in recent weeks, readings of industrial production, retail sales, non-farm payroll, and the PMI have delivered upside surprises. In fact, the April S&P manufacturing PMI delivered the best print since 2022. However, now here we go. The tone under the hood is less reassuring. Some of the strength looks like companies pulling demand forward to get ahead of potential supply chain disruptions, not a clean reacceleration in end demand. So again, I know I threw you another time bomb.
Yeah, and we joke about this, but we don't discuss these issues ahead of time. So we react to them live, and as such, so they're not entirely wrong, right, Mike?
Right.
The reality is, and I'll give you two. No matter how pretty the weather looks like when you're looking out the window, you have to follow the storm clouds. And clearly, there are storm clouds out there, and storm clouds that could develop into kind of severe storms and really make this rosy picture look a lot worse than it is today.
Hmm.
Having said that, the primary thing I got out of that commentary, Mike, is that the consumer's stretched a little bit, right?
Hmm.
We've brought this up a lot in many of these podcasts that we've done, many client meetings that we've done. You know, the consumer is feeling it. Higher energy prices, even if you have the extra dollars in your wallet, boy, it's kind of tough when you go to the pump and you're trying to fill up your car, or you book that airline ticket and the price has gone up, or you get a FedEx or UPS that does a surcharge on your delivery because of fuel prices. So yeah, consumer spending is kind of flatlined primarily because the consumer's going, whoa, what's going on here? This is costing me more than I thought. So you
No,
can have both.
great segue. Because I know one thing you love to talk about, one thing you study constantly is the movement of the 10, and now we have to talk about the 30-year Treasury. The 30-year Treasury bond in an environment that was supposed to have interest rates going down, the 30-year Treasury bond last week was over 5% down. I
The
mean,
30-year, Mike, and I apologize. The 30-year hit a high of 5.19 last time. So in our case, for our purposes, well over 5%. And the 10-year, which is a lot more of an indicator that we look at, crossed over 4.5%. So the higher energy prices are seeping into the economy, Mike. They're seeping into not only the cost of gasoline, that's kind of obvious, but we just mentioned the cost of an airline seat, the cost of food, delivery charges. And part of that is inflationary, and that leads directly to higher interest rates. And that puts a brake on economic growth. High interest rates are negative for economic growth.
right. And that, and so now, with the new Fed chief in his seat, the expectation was for sure we'd have lower interest rates. And now, lo and behold, Dom, an interest rate hike has been priced in for March, or not March, for the middle of 2027. So basically a year from now. And I think that may be a little much, quite frankly. I don't think we necessarily have to bake in an interest rate hike now, a year ahead of time. As you like to say, we don't have crystal balls that work. But the fact that it's even priced in at all, you
Yeah,
never would have
Mike,
expected
that
that.
might be one of the best comments you've made so far, maybe in a long time, where we literally came into this year talking about how many interest rate cuts were we going to get. We obviously saw a president who just pummeled the old chairperson of the Fed, former Fed Chair Powell, because he wanted lower interest rates.
The president wanted,
Today,
let's to be clear, the president wanted lower interest
the
rates.
president is
Yeah.
demanding lower interest
Yeah.
rates. And now he's got his own chairperson in, new. And there's just no way they can cut interest rates in this environment. But sort of insult to injury, to your point, Mike, to your very point, there is at least discussion of raising interest rates. That is a 180-degree turnaround from where we were just a couple of months ago, and
Yeah,
all
but
because of the war.
so Dom, I mean, thank you for saying that because that was going to be my next comment. Although I think we're in week 12 of this war that was supposed to last between 4 and 6 weeks, you still have to think or expect that this thing is going to be resolved pretty soon. I've been saying it right along. We cannot go, well, the administration cannot go into the 4th of July weekend with gasoline at $5 a gallon. Just can't do it.
It would be political suicide, right, Mike? I mean, you got the midterms coming, and you can't just wait till November. I mean, you have to set up your campaigns, and you have to go out there and do interviews. All these politicians, they have no chance of winning anything with gas prices $5-6 a gallon, right? But these things do not resolve themselves in a minute, a day, a week, and in this case, 12 weeks. Even if they decide tomorrow morning, they all get up, Mike, and they all start singing Kumbaya, and they sign some kind of more permanent ceasefire, God forbid, a peace accord. The straits themselves, according to the UAE, they're estimating at least a month before they can really open up, clearing out the mines and getting the ships moving appropriately, at least a month. And before you get oil production back to where it was, it could be 3 to 6 months at a minimum, Mike. So I think higher energy prices for longer, higher inflation for longer, higher interest rates for longer. That's not
Okay.
great news, but I think it's an honest assessment of what we have to look forward to.
So I heard what you said before. I'm going to ask again. Why does the market keep going up?
So we talked about the earnings. We talked about the economy is actually holding up pretty well. Consumers that actually have money continue to spend it. So whether it's going to the gas pump or going to a restaurant, they're continuing to spend money. And then there obviously, Mike, is a hope that this thing does get resolved sooner rather than later. And though it will take some time for inflation to kind of work its way through the economy and eventually roll over and start to go down, most people estimate is that it will be rolling down towards the end of the year. So if we can get through this next stage, I think the overall news will be positive. It's just going to take us a little time to get through it.
I think the other thing, Dom, which we really haven't talked about in quite a while, I think we take for granted that the jobs numbers have been phenomenal. Yes, there's always weakness, but for the most part, and it's been like this for several years now, most people do not have job insecurity. And I think at the end of the day, we're going to get a consumer confidence number this week. But at the end of the day, if you feel secure about your job, about your employment, you'll take out the plastic and buy that new TV. You'll take your family out to dinner on Saturday nights. But when you start to feel some job insecurity, that's when I think people will really start to feel a little more insecure about their own situation.
Yeah, and Mike, to your point, and we talk about this as well quite often. The have-nots in our country, half the population that is struggling, they're not feeling the positive economic data, right? But for the average American, the half full glass American, well, look at the value of their 401ks. Look at the value. You bring this up all the time, Mike. They look at their 401k balances. They look at their portfolio balances. They're feeling pretty good. Hey, things are not all that bad, right? As you brought up, job security. Hey, job is there, and maybe, God forbid, I actually got a small raise. I'm feeling pretty good about it. Value of their homes. In some parts of the country, prices have declined a little bit, but for the most part, they've held up pretty steady. So the average American that is in that top half is not feeling terrible about the economy. I mean, again, the noise, the headline, a little scary stuff, but overall, they're not feeling terrible about their own personal economic situation.
I think what they're most worried about, I was going to bring this up later on in the show, we're going to bring it up now. I think what they're most worried about, and the media has really begun to bang this drum pretty loudly. I don't think they're worried about their job today, but the media wants them to worry, whether it's valid or not, that AI is going to take their job. And then while, yes, if you're invested correctly in some of these companies, your 401k looks fantastic. But there is an undercurrent in many sectors that AI is coming for your job.
And look, I think the media grabs onto certain stories, certain themes, and boy, oh boy, this is a popular one. And I'm not saying it's not true, but we have to dig a little bit deeper into that story, right, Mike? So there are certain jobs that you can argue, I don't know if they're even going to be around 5, 10 years from now. But the flip side of that is there might be more jobs in other areas, in other spaces, and will more than compensate for the lost jobs. So I don't think it's an absolute artificial intelligence is going to come in and none of us are going to have a job anymore. But I think our jobs are going to be different. I think how we use artificial intelligence in our jobs is different. And in the end, we may have more jobs, but there definitively will be some jobs that just don't exist anymore.
But and I agree with you, and I truly feel terrible for those people who might fall victim to that. But I really think about it. Do you remember 20 years ago, maybe even more now, when bank tellers were going to be extinct because of ATM machines, and now you can make a deposit on your phone. So I remember going into a bank 20, 25 years ago. You'd wait in line for 20 minutes, and there could be five tellers working back there. So there are many examples of jobs, well-paying, good living jobs you could do for 15, 20, 30 years that no longer exist, and that's been going on since the horse and buggy.
Yeah, Mike, I'll throw a question to you, but I honestly don't know the answer. So whatever you tell me, I'm going to assume it's correct. But do you think, and we can pick on any of the big banks, and we're not making stock calls, but do you think JP Morgan in total has more job employees today than it did 20 years ago, or less employees than it did 20 years ago?
I don't know off the top of my head that answer, but I would say more, 100%.
Again, we're guessing, and this is just conversation, and we just picked on one particular institution. But I'm going to agree with you, Mike. I bet you they have more total employees today than they did 20 years ago. And yet, technology is completely, as you brought up, technology has completely changed the face of the banking industry.
And on the break, I'm going to ask ChatGPT that very question.
we're gonna let you come up with the answer, but let's look at you and I both lived the days where we used to go down to the trading floor in Wall Street and crowded, right? Hundreds of people screaming and yelling and throwing paper at each other, right? That doesn't exist anymore. But it's hard to argue that there aren't more people employed, not less.
Well, Dom, you and I have been down to the floor several times in the last 10 years, 5 years. So two things. One, it's basically a TV studio. And two, you could hear a pin drop.
It's a different world. And again, you and I don't want to date us both, but you are the senior partner.
So I am.
We can talk about your age, not mine. But the world has changed, Mike. But that doesn't mean. Think of us as a company, as our little slice of heaven. Do we have more employees today or less?
We have more.
More. And obviously technology and how we use it is a big part of our practice, right? So again, I think jobs will change. Definitions will change. Some jobs will be completely gone. Having said that, I think the greater good will be positive, but we have to be sensitive that some people will end up losing their jobs.
Yeah, and there was, as you said, as a result of that, people have to be retrained, and they'll have to, and it may take early retirement. I really don't know what the answer for some of these people are, but that is an unfortunate byproduct of this whole AI thing. But I would argue that AI didn't magically materialize 3 years ago. We've been using artificial intelligence for medical science, for building things, 3D printers, we've been using AI for a long, long time.
And so I want to bring this back kind of where you started the conversation, Mike. You look at what the market's done so well. Well, one of the major reasons is the amount of, we call it CapEx spending, investment in capital, whether it's power plants, whether it's computer chips. We're talking about, close to $1 trillion this year alone being invested in the economy to make our computer technology more cutting edge, artificial intelligence more cutting edge. And that investment, whether it's literally building the plants, the power plants, manufacturing the chips, the labor, the construction of these sites, the construction of these buildings, the people that do that for a living, the people that manufacture Caterpillar bulldozers, for God's sakes. It's all intertwined in economic growth, and private companies are making billions and billions of dollars in investments, and that is reflective in the economy continuing to grow.
And the other thing, we had one of our investment partners in to see us a couple of weeks ago, and they were talking about the defense industry. And one very, very good byproduct of AI and robotics is that wars in the future, hopefully they're never fought, but when they are fought, Dominic, wars in the future will have way less troops on the ground and human beings in the air than ever before, because now warfare, good, bad, or indifferent, can be fought not entirely through AI and robotics and technology, but a lot of it can now.
One of the things that unfortunately has come out of the Ukraine-Russia war, and now we're seeing it also in the Middle East, is that robotics, drones are taking the place of human beings. And so the technology development there is changing on a daily basis. The human toll, again, our heart breaks for especially our own military that have gotten injured or died. But the human toll is a lot less than it could have been because of these technological advances. In the military complex, the military industry is changing because they don't have a choice. Young, smart people are coming into that sector and developing military hardware that these other companies never even dreamed about. So all of this is in flux. All of it is changing on a daily, weekly basis. And tying it back to the economy, Mike, these companies are taking over and bringing cutting edge stuff to the market. And so as we speak, it's changing it all.
And again, I think that's a positive byproduct of AI. And same thing in healthcare, right? I mean, AI is such a useful tool in monitoring your own health and making sure you keep your prescriptions in line, and even allowing pharmacies to talk to each other and just make sure the people are not taking the wrong drugs or mixing the wrong drugs. So I understand the fear about AI taking people's jobs, but I think, as you said, the byproduct of all the good that could come out of artificial intelligence, I don't even think we've begun to think or know about all the benefits we're going to receive.
Yeah, look, whether we're talking about, and we do have a shortage of doctors in this country, we have a shortage of nurses, we have a shortage of medical staff to take care of the elderly. All this stuff that's coming in will augment and assist in helping those people do their job a lot better. We had a guest, remember, who was talking about building these robots that were going to be assisting and companion to the elderly. We don't have enough people to take care of the elderly in this country. So in the end, I think it'll be a positive. Obviously, there'll be some growing pains in the process. We joke about cars with no drivers. They drive themselves. Every once in a while, they kind of get themselves cornered in a spot and don't know how to get out. But overall, it's working. The system is working. And artificial intelligence should make life better for the average person.
And just for the record, you know those stupid golf carts that give you a warning, give you beep when you drive where you're supposed to be, you're not supposed to be.
Well, that would be you, Mike. But yeah, okay, go ahead.
Yeah. So I have been in a golf cart where I couldn't get out either because no matter what I do, I got this golf cart beeping at me. So I understand how the driverless car feels.
Well, the only thing that makes me smarter than you, Mike, on this one is I won't even get into the card because the thing will go, don't be an idiot. You don't know how to swing the club. Just go home. It wouldn't even start for me, Mike. So I've learned that lesson. Don't be an idiot. You don't know how to swing a club. Go
There
away.
you,
Go
there
do
you
something.
go. Well, look, let's do this. Hope Matt is listening to us. Let's take a break now, and we'll talk about some sector rotation and a couple of other things when we come back on the other side. And I will get your answer to the amount of employees at JP Morgan now compared to 20 years ago.
All right. We'll trust Chat GBT to give us the correct answer.
We'll be right back. All right, I'm Michael Hartzman, back with my partner Dominic Tavella on the Lebenthal Report. Dom, I just checked in with our mutual friend Claude, our friendly neighborhood AI, and what he tells me is 20 years ago, around 2005 or six, JP Morgan employed about 170,000 employees. And it was worth noting that it was that high because they just merged with Bank One 2 years prior. Today, do you want to venture the guess how many employees they have, Dom?
I was going to go for more, but for the tone in your voice, I'm going to say a lot more.
A lot more. How about almost double more? Today they have 318,000 employees. And to your point, the recent growth has been driven primarily by increases in the front office and technology employees.
Listen, we have a lot of friends there. Maybe we'll get some of the dirt one of these days, but you have to believe that what has spurred their growth and allowed them to hire more people is being able to use technology to augment and grow their business. So I think so. The dumb analogy we hear all the time is think about when this country ran on wagons and horses, and you had shoemakers for horses, and when horses went away for transportation purposes, they lost their jobs, which unfortunately is true. The flip side of that is think about all the auto mechanics, locomotive, airplane mechanics, pilots think about the jobs that were created because technology advanced. And that's what they tell us the future is going to be, Mike, technology. And we haven't even talked about space yet, and the cutting edge advancements in space and exploration on the moon and Mars. I mean, the future is insanely bright, insanely bright.
You're not going to say the final frontier?
I might get. I hopefully we're around to see it, Mike. But it is exciting. It is insanely exciting that stuff that maybe we heard about and dreamed about when we were children is reality. I mean, the idea that they can put a colony on the moon, and there are real economic reasons why it makes sense. They're talking about within years, Mike. They're talking about within years we could have a permanent colony on the moon,
Yeah.
and not decades, years.
Yeah.
Years.
No, it's crazy. Look, SpaceX is going to go public probably this summer. You and I are getting a lot of phone calls about that. I saw an amazing interview the other day on CNBC. Gentleman was talking about, the concern about data centers, and the harm that some people believe they could do to the economy. And what this gentleman was saying is one of the things Elon Musk wants to do with SpaceX is he wants to put the data centers in orbit, wants to put them in the atmosphere, right? And if you think about that, and if you think about now how space truly can be used as part of the solution to help the environment, I mean, that's potentially pretty exciting stuff.
We've heard, both you and I have been around and heard of Musk for a very, very long time. And you hear some of his ideas and you're like, the guy's just crazy, right? And then he does it. he takes craziness ideas and makes them happen in reality. And we can pick on Musk, we can pick on Jeff Bezos, who's got Blue Origin, same kind of ideas and concepts. But these people are making these fantasies, dreams come true. All of it to augment our world, hopefully in a positive way. We think in a positive way. But when you think about, why is the stock market doing as well as it's doing, a lot of these companies are representative of this future, whether it's artificial intelligence, it's technology, it's computer chips. I can go on and on, right, Mike? I'm sure you as well. But it's an investment today for the future. That's really what we're talking about.
Yeah, and again, like you said, all the byproducts that go into that, and all the people that they put to work, right? So let's talk about some sectors if we can, Dom. I'm looking at my cheat sheet, and no surprise, the energy sector is up 33%. Technology is up 18.4. This one's a little bit of a surprise. Real estate's up 12. Consumer staples is up 11. And then what's really interesting, if you go down to the bottom, financials is the worst sector of them all, actually negative 4.7%, followed by healthcare. And this one, Dom, to me, I think is quite an interesting indicator what we were talking about before. Consumer discretionary is actually the third worst performer. It's up, but up only 2.6. So I'll let you start wherever you want. You want to talk about the winners, you want to talk about the laggards, but I think this list is a little bit upside down.
I guess my first thought is, obviously in the middle of this list is the war, right? So the easy answer is, once the war started, once the Straits of Hormuz were closed down, energy prices went through the roof, right? Cost of a barrel of oil went through the roof. Oil is traded in global pricing. So company profits for these oil companies, for refineries, profits went through the roof. and obviously the stock prices went through the roof. What we have to be very careful here, Mike, is, and we saw it over the weekend, there was some noise that we might be very, very close to some kind of a permanent ceasefire with Iran. And over the weekend, oil and gas prices dropped by like 5%. And then now we're finding out, oh, maybe not quite as written in stone as some people were saying. So oil prices popped up and then they're down. So based on the war, oil prices are going to be very, very volatile. And before you jump in and go, well, that's the sector to be in, understand that that could dramatically change overnight. Would you agree?
No, I think the energy sector is a sucker bet. Absolutely. Right.
At these prices, we wouldn't touch it. I think, as you said it, Mike, and I'm going to agree with you. I think you're 100% right. At these prices, it's a sucker bet. Now, if they come way back down, if there's an overreaction of that pendulum and there's a big sell-off in the price of oil, then that's something we would consider adding to the portfolios. But at these prices and the volatility, we wouldn't touch it with a 10-foot pole.
And I agree with you. And you could argue the logic of the technology sector being up 18%, because we were just talking about all things technology a few minutes ago. But what do you make of the real estate sector being up 12%? That's kind of a pleasant surprise.
I'm going to say yes, especially because interest rates, generally when interest rates are higher, real estate goes lower. Right? Mm-hmm. It's pretty much you can write it in stone. I think it's it's been a really poor performing sector for a long, long time, right, Mike? We haven't had real estate in our portfolios in a really long time because it's underperformed. So it might be more of just a value play. Hey, there's value there now. It's depressed enough that we can buy it at a discount. But again, I'd be really careful on that one. Very much tied to how well the economy does. And again, the economy's been pretty solid. So again, that could be another reason why it's performed relatively well, but we would be cautious on that.
Yeah. And again, real estate is that's a big net, right? So there's residential, there's rentals, there's commercial buildings, there's hospitals, there's municipal buildings. It goes on and on and on and on.
And Mike, just we didn't do a deep dive into just as a bucket, the real estate sector, but a lot of that could be the data centers that are being built. Mm-hmm. Remember, these data centers are being funded by all these the big, enormous technology technology companies. They are helping, assisting in getting these centers built, and then obviously they're going to lease back and use the data processing ability. So part of that performance could be data centers.
Which makes sense, Dom, because industrials is right there, not tied, 1 percentage point lower, up 11.1%. And that would make sense because all the construction and all the digging that's going on in these data centers all over the country and the world.
Yeah, you have to look at which companies, and then the major indices put certain companies, they plug them into certain sectors, and you go, well, what does that have to do with? I think, correct me if I'm wrong, Mike, but I think Tesla might be consumer discretionary, and you're like, well, they sell cars, but would you really call Tesla a consumer discretionary company? So sometimes we have to be careful when we look at these sectors and go, well, what's inside that sector? And then we'll figure out why it's behaving or not.
So let's go to the bottom of the list. I know you paid careful attention to the healthcare industry. Other than we have RFK out there, spreading measles and smallpox and trying to get people not to get vaccinated. People are still living longer. People, are still taking advantage of our great healthcare system. What would you attribute, and I was being a little sarcastic, not entirely sarcastic, but what do you attribute healthcare being a laggard this year?
Exactly what you said, Mike. I think you put your finger right on the pulse. We have an administration that is looking to cut costs. And so they're being very aggressive in negotiating prices on prescriptions, on healthcare services that Medicare and Medicaid pay for, i.e. we pay for through our tax dollars. And so there's a fear out there that the profits of these companies are going to be cut, are going to be hurt by this aggressive policy, cutting Medicare costs and Medicaid costs by the administration. That less dollars will flow into the healthcare sector and these healthcare companies. Having said that, again, I think you're spot on, Mike. I think you hit the nail on the head. We as a population are getting older. No one is cutting the pills that we're taking, or if you need a bypass surgery, nobody's going to skip it. If you have a broken leg, nobody's not going to go to the emergency room. So we have an exposure to healthcare in our portfolios. We're going to maintain it. And ironically, it's starting to rally a little bit. I think the realization these companies still can make a lot of money, and their profits are going to stay up and hold up pretty strong. So we like healthcare a lot.
Okay, and for obvious reasons, and I completely agree, and I'm glad we have that allocation. And then the last one, Dom, is financials. Now, financials, again, I think it's a little overblown how it's so interest rate sensitive. But we know now that interest rates are not going to drop through the roof, through the floor. They're going to stay relatively stable. I think if the economy is strong, people are going to want to borrow money. I talked to 3 clients in the last week who have loans out at the Small Business Administration. People are investing in their companies, in their homes. What do you attribute the financial sector really being just god awful this year? Down almost 5% when the S&P is up 10. It's a big disconnect.
Big disconnect. And again, I'm going to tie that one to the consumer, Mike. So we've done quite a bit of homework on the financial sector. And when you break into what's in that sector itself, obviously we're going to say the big banks, but think of also like a Visa or a MasterCard or a Capital One. And that's particularly where the sector is getting hurt, because if consumers slow down their spending, if consumer default rates on credit cards or car loans, God forbid mortgages, is higher, these financial institutions get hurt. So again, 5% negative is not earth shattering. But to your point, Mike, when the markets are up 10 and they're down 5, that's a big swing, right? But I think it's fear of economic growth and the consumer's ability to spend money. And that's why those particular companies are actually negative for the year, even though consumer spending has actually held up pretty well. If you look at the credit card companies, if you look at the smaller banks, very tied into the consumer. And I think that's one of the reasons they've gotten beat up. Maybe unfairly, Mike, but I think one of the major reasons they've gotten beat up.
And one topic again that's near and dear to both of our hearts is that lower third of the economic stratosphere. We've talked about our clients who are the upper half if they have financial advisors. And the word affordability has become a dirty word in this administration. But to your point, if that lower part of the economy is buying food on their credit card and they can't make their credit card payments, that's not a great recipe.
And unfortunately, Mike, it might be even a little bit worse. They're getting close to maxing out their credit card.
Right.
And default rates are a little bit higher. Car loan default rates are a little bit higher. I apologize, I don't remember the exact stat, but the number of people that are underwater on their car loans, meaning if they sold their car tomorrow, the amount they owe on the car loan is more than the value of the car itself. And the number is staggering, Mike. If people that have car loans, the number is very, very large. So all of this depresses not only bank stocks, credit card company stock, but also future economic growth. So it's all intertwined. So
and I had an old car guy.
It's inflation and it's consumer. It's higher interest rates.
And what you just mentioned, Dom, is really interesting because I had an old car guy tell me once the easiest form of credit you can get is a car loan, because the banks know you're going to make that car loan payment if it's at all possible. because you need that car to basically live. You need that car to get to work. That
Let's
car
talk
is a
about that. Like
life.
just getting back and forth to work. You might skimp on something else, but you're going to keep that car because you have no way of getting to a supermarket to get food, going to your job so you can actually earn a paycheck. And yet default rates are increasing in car loans. So again, it's not dramatic, it's not earth shattering, but the idea that if the economy is doing this well, why would we see defaults? Because the consumer on that end of the spectrum is hurting. They're hurting.
You know what? With the time left, we spent a lot of time covering things going on in the U.S. Let's look at the rest of the world for a minute. We sometimes are so narrow in our scope, only looking how, say, the war in Iran, how does it affect just us here in this country? The president was just in China. I think it's good that China and the U.S. are on speaking terms. The developed IFA index year to date is up 8.5, which is solid. But the emerging index, Dom, year to date is up 21%. And over a 12-month period, the emerging index is up 48%. And you and I joked around for years. No one ever wants to talk about emerging market, but emerging markets have really been where it's at for about 3 years now.
And we're blessed that we have an exposure in some of our portfolios, both to international and emerging markets, and it's a tale of two cities. Some of these emerging markets, we joke about this. Are they like China is categorized as an emerging market, right? South Korea is characterized as an emerging market, or Indonesia. These countries are more developed than some Western countries. So sometimes it's just the index has certain countries in there and it looks better. But having said that, they seem to have their financial houses better in order. We are in a natural resources boom, so that helps these countries a lot. Taiwan with computer chips, I can go on and on, but we have an exposure there. We like emerging markets. We think, at least for the foreseeable future, it's a good place to put some capital and keep it there for a while.
I'm glad you mentioned natural resources. So, not to sound like a broken record, tell me again why natural resources are doing well.
I'm sorry, Mike, I missed that.
I said I don't want to sound like a broken record, but I'm glad you mentioned natural resources. Just tell me why, again, natural resources are doing well. It's because of what sector?
Are we? I assume you want us to tie this back into technology.
Exactly. And data centers.
And so we can talk
AI.
about rare earths, and we can talk about battery technology and lithium, and we can talk about oil. But at the end of the day, all of this stuff goes into the manufacturing process that is cutting edge, that leads us right back to technology. So a lot of this stuff is not held in the United States, or worse, we have it, but for ecological reasons, we don't mine it, we don't develop it, we don't refine it. But back to emerging markets and international, one of the many reasons why we think we need to maintain an exposure in those markets. But we love natural resources, and we think going forward, it's definitively a good place to keep some of our eggs parked in terms of our portfolio allocation.
Yeah, and again, it ties into a justification for keeping our emerging market allocation intact as well, for similar reason.
But I can't imagine us using less going forward, Mike. Can you?
No.
I mean, and if you think how fast technology is moving and how many, again, we talk about data centers and computer chips, we're going to need more, not less, for the foreseeable future. And that could be years, decades.
Right. And I'm looking at the price of some of the commodities. Copper was $9,493. I don't know what, maybe you do. Last May, and now it's $13,545. So that's a big jump. Silver has doubled. Um, Gold, I mean, gold has gone up as well, but gold is not even used as far as rare earths. It's not really used in anything. So yeah, I mean, the price of these things has really skyrocketed in the last year. And as you said, I don't think we're quite done yet.
Yeah, and look, and it's easy to have that conversation with gold. There's definitely a speculative nature to
Yeah.
investors coming in and gobbling up as much as they possibly can, and then they decide to get out of it. Gold again is another perfect example where it rallied way high and now it's come back down to earth a little bit. But it's hard to argue you're not going to need this in the future. And again, we're not speculating. We don't do that with our portfolios. But to put an allocation, have some dollars in this area, I think it's just common sense.
All right, with the few minutes we have left, another loaded question. And we talk about it all the time. You and I did not talk today at all. So you are not prepared for this question. What are you worried about for the next 6 months? And what are you most optimistic about in the next 6 months?
I always say what I worry about most is what I don't know.
Right.
Uh, you've heard me use the line, the meteor that comes out of the sky and hits you in the back of the head. But I do think that people are underestimating inflation in the short run. I think that these problems caused by the war in the Middle East will resolve themselves, but they don't resolve themselves in a minute. And we talked often about this, but let me remind people there's a lot of infrastructure in the Middle East that's been destroyed, not only in Iran, but in Saudi Arabia, the United Emirates, Qatar. I can go on and on. A lot of their refineries, their oil producing equipment, a lot of it's been destroyed. It doesn't get all fixed in a day, a week, or a month. We don't talk a lot about it, Mike, but the war in Ukraine and Russia, Ukraine has done a really good job of punching the Russians in the face. And they do that by blowing up their oil refineries and production facilities. They don't get fixed in a day, a week, in a month. And so oil prices, I think, will stay unusually higher for the foreseeable future. They'll be lower than where they are today, but I think they stay higher for longer. And I think that will surprise the markets a little bit.
What are you optimistic about?
Oh my God. I don't know if you caught that interview with Jeff Bezos on talking about the going to space. And you already brought up data centers in space and satellites in space and colonies on the moon that will use material on the moon itself to manufacture computer chips. The silica on the moon apparently is very, very productive for manufacturing. Gravity and the ability to send spacecrafts to Mars. I mean, the future is so bright. If we could just get there in a healthy way, it will be amazing. We will talk about it much the way we talked about the internet and Wi-Fi in the 90s. Mike, you and I were there, and the dreams of what people thought it could be, they only had it 10% right. It was 1,000 times more than they said it was going to be. In hindsight, it was 1,000 times more than what they said. And we couldn't even fathom it. But look where we are today because of it.
Dom, you know who had it right? George Jetson had it right 60 years ago.
Look, again, we grew up with this stuff and we thought it was just, pie in the sky and it was Star Trek and it was just other mindless stuff, right? But the reality again is, and this is where we talk about the bubble in technology. The bubble is at the company level, which companies will survive, which will be productive, which will be profitable. But artificial intelligence will change the world as we know it. Obviously, we all hope for the better. Very optimistic.
I'm optimistic as well. The thing that I'm somewhat nervous about as we head into the second half of the year is that we don't have a clean exit strategy out of this war. I mean, every weekend there seems to be an announcement at 11 o'clock a.m. that we're very, very close, and by 11 p.m. we get tweets that we're about to blow the country off the face of the planet. So I think going into the summer, as I said earlier in the show, with higher than expected oil and gas prices, can begin to wear on the consumer pretty quickly here in the dog days of summer.
Yeah, I think you're right, Mike. So I'm going to go back to what do I worry about? Exactly what you just said. Not that it doesn't get resolved, but it takes longer to resolve. Again, there's inflationary expectations get higher, interest rates stay higher for longer. I think it's a short-term problem, but short. Would you be surprised, like if we said 3 months? Not
No, no.
right. I
Look,
mean,
what when the administration said that we're going to be done with this in 4 to 6 weeks, you and I said on this show and on our morning call, well, we hope so. We're both skeptical, right? I'm not really shocked we're still talking about it 12 weeks later, Dom.
Yeah, look, Mike, maybe it could have get resolved that fast, and then more people would have died. So maybe this strategy in the end proves to be correct. But I don't think we're going on a limb by going higher for longer.
Oh my
Higher
God.
oil prices, higher gas prices, higher energy prices, higher inflation, and higher interest rates. So hopefully, again, that rolls over within the next couple of months. But I think the short-term implications are pretty reasonable,
Yeah,
even if we
and I
don't like
agree
them.
with you. If we have to have higher gas prices for a little while longer, and not having our soldiers killed and maimed, I think that's a good trade off. I agree with you. Well, look, we are out of time. I always appreciate, as I always say, when it's just me and you doing a show. I love our guests. I love when you and I could just kind of spend an hour and talk about what's been going on for the last couple of months. So,
It doesn't hurt, Mike, and again, it doesn't hurt to make sure that our clients and our listeners have an honest opinion. We don't really sugarcoat it, but I think an honest opinion lets people deal with the volatility a little bit better. And to think that we're not going to have a little bit of volatility going forward is kind of silly. Wouldn't you agree, Mike?
yes,
But
volatile. Now,
this too shall pass.
yes. You like the meteor example? I always, my analogy is a 2x4, same thing. Volatility is always there to stay. So, on that note, we will be back next week with a new edition of the Lebenthal Report. Have a good night, everybody.
Good night, all. Good night, Mike.